You're listening to Storage Nerds Podcast, where we unravel the best-kept secret of the real estate investing world, the storage industry. Join the grassroots guru in self-storage, Stacy Rossetti, in insightful discussions about finding, funding, and running these spaces, allowing you to yield the highest returns possible. Get your foot in the door on self-storage and discover how to properly purchase facilities, negotiate with sellers, and close the deal without worries. Start unpacking that investment wisdom with Stacy right now.
All right, welcome. Introduce yourself in the chat. Say hi. Welcome to all my new students. Welcome to the Monday night session. This is where I teach. This is where I kind of go over my opinions. I show you what I know. I go over, let me see what else. Let me pin myself here in Spotlight. Okay. This is where I teach and go over your next steps and things like this. So thank you for hopping on. I appreciate it. I see a whole bunch of people here. Some of you I've talked to over the past week, which I'm looking forward to talking to even more people this week. I talked to so many amazing people last week, honestly. I mean, I just love learning people's stories and things like this. So last week I had the Storage Nerds doors open, and this week as well too. So if you're interested, you can go to storagenerds.com and you can set up an appointment with me. But that's where I get to actually meet and talk to people and hear what your goals are and hear your story and talk to people all across the country, which was really cool. And there's just so many cool, amazing people. I just love being able to meet you guys and hear your story and listen to what your goals are, not only in storage, but also in life. And everybody that I meet to is just everybody just does there's so many different types of people out there, so I just love it. So again, thank you for your time for that. Now, Monday nights, I meet here every Monday night, and you can talk to me. And, you can ask me questions and things. Now, this Monday night, what I wanted to talk about was the market. I feel like there's just a lot of questions about the market. And so when I'm talking, you guys can put your opinions into the chat. All right. Because the truth is, we have no idea what's going to happen. Right. Everybody can sit there and try to look at the data and look at, and they come up with their opinion or whatever, but I'm one of these types of people that I really try to educate myself on, what's going to happen. And I really try to, not only on everything I'm doing, but on what's going to happen. So, and you guys tell me in the chat, if you're like this or not, but I follow very, very closely, a lot of different, data companies. I'm one of these data nerds. Follow Redfin and CoreLogic and a lot of real estate investing or real estate outlets and stuff like this. And I don't really do I don't really follow a lot of people on social media. But I do watch a couple of YouTube people as well. And I'm just over the past, not just a couple of years, honestly, but the past couple of months, I've just really been trying to just keep on top of how the real estate market is going. And so I just wanted to talk a little bit about that today, because I'm in a group, I'm in a private group for storage investors. And there was a question that came up about this. And there are some people out there that are talking about the market. Really, my topic today is going to be how's the residential real estate market going to affect the storage industry? That's really my topic. And I don't have graphs and charts or anything like this, because you can really go on to to Redfin or CoreLogic and look at this. And I wanted to show you just a couple of people that I follow and listen to, and I've been following for a while, that I think are just smart people and smart people in the industry. But and I wanted to get y'all's opinion too. I would love to hear what y'all think about what's going to happen. And actually, in the chat, do me a favor and let me know, do you think about like the real estate market and like what's going to happen? Or is this like something that you're just like, it's not on your radar? Do you follow anybody? I would love to know if you follow people, who you follow, because I'd love to learn who everybody follows, really true. And just see what everybody's opinions are out there, and the truth is like, if you go onto YouTube, and you can do this now, but if you go onto YouTube and you type in like residential real estate, you will get like a ridiculous amount of like videos coming up of like people talking about like real estate. Now, if you talk about like the real estate market, and you Google that, or if you look in like YouTube and try to watch videos or whatever, you get so many different types of videos. You get like so many different types, right? But the truth is like, if you go into YouTube and you type in like commercial real estate, like nothing comes up, like hardly anything comes up. And if you type in storage, like the storage, storage industry or storage market, right? Nothing, like hardly anything comes up. There's like not really a lot of people that get out there and talk about commercial real estate. Now, I'm not the person to do this for sure, but I would love for somebody to be that person. That's like, the commercial real estate guru, the commercial real estate market data person. Now, Marcus and Millichap, I know they kind of do some videos and stuff on this, and they do webinars, but I feel like Marcus and Millichap, they're like so high level a lot of times. Like I go to all their webinars and try to listen to like what the stats are and data and stuff. But a lot of times I feel like the people that are in their webinars are always like REITs, are always like big players, or like super big players. It'd be great to have somebody out there in the world that really represented like the regular people, like all of us, like what's going to happen in the market. And this is what I'm thinking all the time. And I've been thinking this for years, ever since like before COVID. Honestly, the truth is that I've been thinking this even before COVID, because I know that the real estate market goes in cycles, right? Does anybody know? It's a pop quiz. Does anybody know like typically how long the market is in an up cycle, or how long the market is in a down cycle? Over average, like over the last 100 years, typically what's the average of an up cycle, and typically what's the average of a down cycle? It's a pop quiz. Put it into the chat so we can talk about that. But historical data basically says like over the course of 100 years, an up cycle and a down cycle typically take this much time. Okay, so we know that like the real estate market is just it's just a cycle. Really, there's a lot of ups and there's a lot of downs. Now, obviously, the past 2 years, there's been nothing like this ever. And so when you start looking at data, like you'll see like, you typically see like data going up and down like this, right? And then on like in the last couple of years, it's like, and then it's starting to go down now, obviously, but it's just like, it's been like so volatile. I feel like everything is just so volatile the last couple of years. But I know that typically, a real estate market will last anywhere from 8 to 12 years, right? So the whole cycle will last 8 to 12 years on an up cycle and then a down cycle. So we've been obviously since like 2008, maybe in the up cycle, or 2009, maybe in an up cycle. Right. And we're coming down, like, I guess it's, 12 years later. So this cycle has actually really taken a long time. Sometimes the cycles are around 8 years. And then sometimes they're like, 12. So we're in like year 12 going into 13 or so. We could say whatever you want, whatever years, but 10 years, 12 years now. This has been like a really, really long cycle. And so people, so the question is, what's going to happen? What's going to happen in the next couple of years. And everybody knows that, right? The interest rates are going up on the residential side, right? Everybody knows they went up by 50 basis points, I think, like the other day, right? So, and interest is going up. And actually the truth is, like, I don't know if you guys are in Facebook groups or not, but you guys tell me what y'all are seeing out in the world. I'm in one Facebook group right now where it's a Texas Facebook group for real estate investors. And they're saying, like, there was a post about a person that just got a loan on the property, an investment property, and he's paying like 6.67% interest. 6.67% interest, and he put 20% down. All right. That's a high interest rate. Now, obviously, it's not high in comparison to what the historical data shows, right? Because back in the day, people was like way up high, but it's high compared to what typically normal people know. So in my mind, I'm just thinking, like, in terms of storage owners and storage facility owners, what is going to happen to the market, right? What's going to happen to the market over the course of the next couple of years in the storage industry, right? Now, this is the question. That's the question of the day, right? And, and I just got off a coaching call with a student, and I would have gone into this with him and gave him my 2 cents, but our coaching call was coming to an end, and I had to jump off the call, and I don't see him on here. So he's not hopping on, but essentially he's looking at a storage facility right now in New York, in the Finger Lake area. Okay, is where it's at. Okay, and so it's a 90 unit facility, and it was about like 12,000 square feet or something like this. It was right around, I think, like 12 or 13,000. I can't remember the square footage, but it was 90 units. It was making around 100, a little bit over 100 grand a year. Okay. And the owner wants $800,000. Okay. So if you run the numbers on this, and for all my students that are joining, and you guys are all going to come to the boot camp, so you'll be able to see me run numbers. I'm not going to run numbers now because I just want to talk about this. But essentially, if you run the numbers on an 800 unit facility that's making 100 grand, and it's 100 units, I mean, typically that facility, and it came out to the value of like, $900,000 at a six cap. And that was one thing that I talked to my student about. And that's really kind of that's a question of the day when you run deal analysis, is what's the typical market cap rate going to be, right? And so we were running those numbers at a 6 cap because it's New York, and New York tends to be more expensive. And and so we were looking at it this way. The Finger Lakes area, if you guys know this area, is a tertiary market. And I don't know is it considered a tertiary market? I'm not sure. I would definitely say secondary to tertiary. And if you guys know this area, and I do know this area very well, it's very beautiful. And I had a student actually buy a facility in Binghamton, if y'all know this area. And so I know, and I remember the numbers that she had as well too. So that's why I know the typical area is around like a 6 cap. We were running the numbers, $800,000 at a 6 cap. I'm sorry, it was $800,000 purchase at a 6 cap. It was being, and it was making around 100 grand. I think it was $108,000. And it was about 12,000 square feet, and it was 99 units or so. And it came out to a valuation of $895,000. And the taxes were about $23,000. There was no utilities or anything like that. So we're looking at the numbers. And he was basically saying, would you buy something like this? Personally, for me, that's like, when I see like income producing property deals, that's like a typical income producing property deal for me. That's a very, very typical deal. Those are the type of deals, when you see that, you want to hold on to those. That's a good buy and hold property, right? And we were looking at the competitive analysis, right? So all my students essentially fill out a sheet. where you do the competitive analysis. You look at all the competitors, and in the area there was a couple of competitors, and we were looking at, of course, climate controlled versus non-climate controlled. And in the area, he said that he called all the competitors, and the non-climate controlled was not filled, but the climate controlled was filled. So maybe in New York, people want like heated storage for the winter, when they want air conditioning in the summer. I'm not 100% sure. But one of his competitors was Bolt, right? If you guys know Bolt, Bolt is like kind of it's a bigger, like, not franchise, but it's a bigger like company that owns like a whole bunch of storage facilities, typically in the north, like in New York, but they are spreading out and they're going east, they're going all over. I know the owner, and he lives in Georgia, and his prices, and then there was one other competitor that their prices were like way above everybody else's. All right. They were at like for a 5x5, it was like, like a 10, sorry, not 5x5, a 10x10, it was like $125 a month. Right. Whereas everybody else was like $60 or $70 or $80 a month. Now, when I see all the competitors, and these were for non-climate controlled units, and he said, and my student had said he called all the competitors, and some of the competitors actually had climate controlled and non-climate controlled, and some of them, just had non-climate controlled. All the ones that had non-climate controlled were like not 100% full. They were anywhere from like 60, 70, 80, 90% full. But if you had climate controlled, you were full, right? Everything was full. All right. Now, so my thought for that, first of all, is like, what does New York call for? Does New York call for climate control? I mean, typically overall in the industry, it's really kind of an 80-20 rule. You guys tell me if you see something different, but I see really 80-20. 80% is non-climate control and 20% is climate control. Now, there might be a little bit more climate control coming out, but I feel like there's still like, there wouldn't be any more than like a 70-30 split. Typically, most of it is going to be non-climate control. So maybe in that area it calls for climate control. But so what I'm thinking in terms of market, so I'm thinking of like competitive analysis. I'm looking at like that deal. And I told him anyways, I said, put an offer in, because the guy wants an offer, that he wants to sell his facility. So I was like, you have to put an offer in. If he wants to sell his facility, you put an offer in. Even if the offer is not like what he's asking for. He's asking for $800,000. And so like the student was just a little bit hesitant, first of all, because it's not like a smoking hot rockin' deal. I mean, the truth is that your very first deal is going to be like, it's not like a home run. Your very first deal is just like, let's get our foot in the door and let's just get this going. Let's create some momentum. Let's get out there and let's just do this, So if you sit there and you're waiting for your very first deal to be a smoking hot deal, which I see a lot in my students, and I'm like, just put the thing under contract. Like, it doesn't matter. Let's just try to figure out what we're doing. Then just miss out on a lot of opportunities. And the truth is that there's a lot of people out there that would buy that facility. It's at a 6 cap, it's worth $900,000. You're going to pay, you pay at the most $800,000 because that's what the guy was asking for. And essentially when we looked at the competitive analysis, you could take it from 72 cents a square foot to minimum 80 cents a square foot, but maybe even more. And so you're going to create that appreciation over time and have a little bit of money on the back end when you sell the facility. It was going to go from like 800,000 to like, $1.2 million or something like this, in like a couple of years. So, so that's a good buy and hold facility. So what I'm saying first and foremost, before we get to what the market is that when you come across deals, And even if it's just an okay deal, right? It could be a good buy and hold strategy. And that's really what you want to look at. And you don't want to pass up those deals. You really don't want to pass up a deal, even if you think it's just an okay deal. Now, I had one student in Storage Nerds that it was a female, and she was just like, I'm gonna get out there and find some deals. And every deal that she found, like in the first year, she bought 3 facilities. And every deal she found were like okay deals. They were like not like smoking deals, but okay deals, right? And now she's about to sell one. She's had them for like 2 years. She's going to sell one, and she's going to make like a couple $100,000 on it just by selling it. And that's a pretty good deal for me. I think that's a great deal. So don't pass deals up that you don't think are going to be good. Now, in regards to the market. All right. You're just going to have to consider a deal like this in New York that we find as like an okay deal. I would be just knowing that I'm going to have to hold on to this deal until after, we get past like, what's happening in the next couple of years so we can see what's going to happen. Now, is the storage industry going to cool? I don't know. In my opinion, I really feel like now, so what I was going to say first is like, first of all, during COVID, when COVID hit, right, for us personally, now you guys all know what kind of deals we own. We own like deals that are, smaller secondary or tertiary market facilities, like the one that you see in the back here. This is exactly like all the facilities that we have. And, we were already virtual before even COVID hit. So we already had everything. We were 100% virtual. And we already had like, everybody just went online to make a reservation. We have like phone support. We have boots on the ground people that go and just manage our facilities for us. And it was really, I would say it was mostly virtual, for us. And so when COVID hit, we really didn't have that big of a deal because a lot of storage facilities in the industry, they were not contactless. And you already know this. I talked to one lady this past week, and she works at like one of the big REITs. She works at one of the big REITs. And she wants to buy her own facility, and she's that one person. So she works at a facility. Let me see if she's on here. I'm not sure. I told her to come and listen in. Let's see if she's here. No, she's not here. But she works at a facility that has 722 units. And she works like she's the office person. All right. So if you come in and sign the contract or whatever, you want to pay your bill or something, she's the one that does that. Okay. And then she also has to clean out all 722 units, and she overlocks and unoverlocks and all this kind of stuff. So it's a huge, big facility, and she makes $13 an hour doing that. She says she's like running around like a crazy person all week long, and she works Monday through Friday. All right. Now so that's like not contactless. All right, that's not contactless. And so even some of the bigger players still are not contactless. Even some of the bigger players you still have to go in and sign the contract because I talked to her, and that's what they do. You have to come in and sign the contract. And so anyways, my point is that when COVID hit, all right, we did not have this issue at all because we were already contactless. But also when COVID hit and everybody started freaking out about like payments and stuff, especially on the rent side, the residential rent side, right? And then we had this like huge discussion in the industry. I don't know if anybody has been in the industry, that long, but like this is like 2.5, 3 years ago, whenever COVID hit. And so we had like this huge big discussion in the industry about like tenant rights, right? And like, what can we do what can we do in this, in this industry, just in case somebody doesn't want to pay or whatever, like, can we kick them out still, or should we evict them? And like, there's this whole big like topics, like this whole discussion that came up. Okay. And so the question, like, and that came up for us as well too. So we had like 1,000 doors. We had like 1,000 doors at the time. Okay. And out of the 1,000 doors, I think we probably had like maybe 20 or 30 people that didn't want to pay, and they didn't want to pay their $50 or their $100 or whatever, you know what I'm saying? So out of 1,000 doors, I think we only had like maybe 30 people max that didn't want to pay. And so Pete came up with, like, essentially what he did is he came up with a form that said, like, okay, your payment is now in forbearance or whatever, and like you can pay this, like you can make a payments on it over the course of the next 3 months. He was like super nice about it. So he did not kick anybody out. We didn't do any auctions. We were the nice people. We were like a typical mom and pop shop. Okay. And so we did not kick anybody out. We worked with everybody. Everybody made their payments. And I think out of like 30 people, maybe like two or three people didn't make their payments. Okay. So we didn't really have any auctions or anything. And so we had like no issues. I'm telling you, like when COVID hit, we had like, it was like, it just kept on going like it was normal for us. Okay. Now, luckily, we were already virtual. We were already contactless. Pete immediately came up with some sort of payment thing that everybody can do if you didn't want to do it. We let everybody know. We emailed everybody in the software, and we let everybody know that if you had any issues at all, please let us know. And then we were just worried, like, when the next time that the month came around, how many payments were going to go through? How many payments could we actually pay? All right. And so we just have to see, right? And I remember that next month, I think that we were all worried about how many payments were going to go through. But the truth is like everybody went through. Like pretty much everybody went through. Like 80% went through, which it's typically on the first. This is what it looks like. Like 80% go through, and then 20% don't go through. And then from the first until like the 6th or 7th, like whenever we do our overlock, we're just hounding everybody and trying to get everybody paid. And pretty much everybody pays, maybe like, except for maybe like 3 or 4%. Okay. And then that 3 or 4% goes into overlock. And then that 3 or 4%, we're working until like the 15th, because then they get charged another fee. And then and so that's kind of how it is. Like we're like our phone support people, one of their main jobs is to like make sure everybody pays. And like typically everybody does pay. All right. And then by the 23rd, when we start the auction process, pretty much everybody's paid, because they get an email. It's like, hey, just letting you know the auction process has started, and then everybody pretty much pays except for like a couple of like people that don't do that. Okay. And so anyways, like during COVID, really nothing for us changed. Nothing for us changed. Now we are like a mom and pop shop. All right. So we're like typical like mom and pop, storage facility owners. Okay. And what I'm saying is that because of that, over the course of the next couple of years, and us seeing that during the COVID time, us seeing that if you have it together internally, right? If you have it together, people are going to be okay with paying $50 or $100 a month. All right. Or $150, maybe $150. Like we have some $150 units. Now we really don't have a lot of units over $150. All right. This is the key. We don't have a lot of units over $150 a month. We don't have a lot of climate control units where people are paying $150, $200, $250, $300 or whatever per month. So we don't really have a lot of units that are over 100. We don't have any units that are over $150. Like we just haven't bought facilities that have those size units. So my point of this whole entire story is that going forward in the market, when you look at facilities and you look at what size units your facilities have, the price and the size of the unit is going to be key over the next couple of months, or over the next couple of years. Okay. In my personal opinion, this is my personal opinion. All right. Is that it's going to be a lot harder for people to be paying for, $200, $250, and $300 facilities, or not facilities, units. Okay. And so I just want you to keep that in mind when you get out there and start looking for units. Now, we were just looking at this one in New York, right? And I guess the owner of one of the facilities said, all my climate control units are all full, and my non-climate control units are not full. So, the question is really, how is the market going to shift over the next couple of years, and what types of units are people going to want, now and be able to pay for? Right? Because what I do know in the industry is that climate control units right now are like really, really expensive. They're like really expensive, and so as we go through the correction of whatever happens, right? Because we don't know what's going to happen. As we go through the correction, we already see, I pay attention very heavily to the residential market, and there's a lot of price drops right now. And so I just feel like there's going to be a correction. Like, I don't know how much the correction is going to be, but there will be a little bit of a correction. You can see that the mortgage interest rates are going up. And you also know that the federal government owns a lot of property right now. All right. And the federal government has control of that property. And they're really trying to just, basically the federal government came in 10 years ago, tried to fix things, screwed them up. And now they're coming back in again. They're going to try to fix stuff again, because that's how it works, right? So over the course of the next couple of years, and you're going to see like the government come in and try to correct some stuff. And so we have to go through that, right? So thinking about like how the mortgages are going to be, and how the and what people are going to be able to afford. Because I'm going to tell you, over the next couple of years, the word of the year is affordability. The word of the year. And right now it already is. Like, a lot of people are just saying, like, can I afford that? Right? Can I afford that? Right? And so, and you guys tell me what y'all are thinking. I would love to hear in the comments what you guys are thinking about this as well too. But I just feel that the word affordability is going to be a very important word over the next couple of years, in terms of just budget for yourself, and budget for what you purchase, and budget for like property, and then this kind of a thing, because I feel like prices are kind of getting out of hand. Now we have a food crisis, and we've got the mortgage crisis, and we've got all this stuff happening and stuff. So long story short, my personal opinion is that you want to just pay attention to what your price per unit is going to be. So remember, in the investing world, and I come from the investing world, right? All these investors, they just want to push those numbers. Right? I get it, because I was in that world. I rehabbed 100 homes. I mean, I know, right? And you just want to push those numbers because your budget on your construction, always like went way over. So you're like, let's just put it on the market for like more and see if somebody will buy it, And so, and a lot of people in the storage world think this way as well too. Like, let's just push those numbers. The REITs are really kind of paying attention to what can the market's demand, be at, right? What can we actually push those numbers to see? And there's nothing wrong with that, because essentially you're running a business, right? And so that's just how it is. But there's going to be a point, right? There's going to be a point where the number's not going to work anymore. And then it's going to have to come down. What's the number? I don't know. It's different in every market, right? But you just have to keep in mind, what can people afford in the area that you're in the market that you're in. And that is going to be the question of the year. All right. So when you get out and you look for facilities and you look for like, what areas you should be focused in or anything like that. You just want to keep in mind how much price per square foot or what the unit's going to be. Because I'm seeing, like, I'm going to tell you, and I'm going to go over this in the boot camp, the 3 different types of like facilities that we're seeing right now. But like, I'm seeing markets where mom and pops like me did not raise the rents before COVID because they're just nice people and they don't want to raise the rents, right? Like us. And then COVID hit and they didn't raise the rents. In fact, they helped a lot of people. And then after COVID, now they're like, well, I need to raise rents, right? But they can't raise the rent high enough because you can't double or triple the rent. And they just, over the course of the last couple of years, did not raise the rent. And so they missed out on all that opportunity. And now they're trying to play catch up, but they can't play catch up because then it would basically like double or triple the rents. And you can't like just, triple the rents and be like, sorry, so, because then you really piss everybody off. And us as mom and pop shops, like, I don't want to piss anybody off. I mean, I want people to stay, but I also at the same time want to run a business, right? And that's kind of how my mentality is. And that's, I'm sure, how a lot of people here are. And there's a fine line between pushing the rents and keeping people in and keeping people happy and stuff too. So now, the bigger players, obviously, they just like, the market calls for this, I'm putting this in. That's it, right? You can stay or you can leave, right? And so that's why they have so much turnover. And it's true. I mean, primary market, bigger players have a lot of turnover. They don't stay very long. Whereas like secondary and tertiary owners like us, I mean, we've got people that have been since we've been doing it, 5-10 years. I mean, we have people that have been like, they stayed and they've been there for like 10 or 20 years. Our very first facility, this facility right here, we have people that have been in this facility for like 10-15 years. And so, we know them, they know us and stuff like this, because in the very beginning, our very first facility, like we were down there all the time trying to clean the thing up and people like, hey, this is Stacy and I'm the owner and stuff. Now we don't do that, obviously, but so we know a lot of the people in this facility. So anyways, my point is that you just have to be cautious on the types of facilities that you buy. And the ones that I'm seeing are the ones that I think are going to be very good buys, are the ones that haven't caught up to what the market is now, but is the market now too high? So like we looked at like Chris, my acquisitions person, and myself, we looked at it. We just put we put an offer on a facility for $1.1 million. And we're working out with the owner now, the negotiation contract and stuff like that. And his rate is like $1.10 a square foot. And he should be, as of right now, he should be at $1.66. Now the question is, like, should we raise those rates to $1.66? That's a lot of raising right there, or should we be a little bit, should be more cautious and not raise them? And so we've really we guesstimated like $1.50 is what we said. And so how about at $1.50? That's a good price for us to raise the rates to. So you don't want to look at the rates and be like, oh, $1.66. Yeah, because what's going to happen in the next couple of years? I'm not sure. Is the market going to keep going up or not? All I know is I ran my numbers at $1.50, even though it called for $1.66. So that gives me a little bit of a buffer, right? Just in case, And maybe over time, if I hold on to this thing, maybe it will get to that rate, but at least I know I'm being conservative. Okay. And so, and then another thing too, there are some people in the industry that are very scared about what's to come. When you have there's all different types of people that invest in the industry. There's all different types. I love this industry because there's like mom and pops like me. And then there's like middle of the road and there's like the huge REITs and stuff. And some people get in and they're like me and they're like, I just want to like live in an RV and travel and just like run my facilities. And then there are some people that are like, I want $100 million or $100,000 and $100 million in asset. And that's like what I want. I want to have like go big or go home. Right. And there's nothing wrong with any of those. Okay. But I can tell you right now that the people that have $100 million in assets, they're sweating a little bit right now. All right. They're sweating because what does the market call for? You know, what is going to happen in the market in the next couple of years? You know, especially if you own these big, huge primary market facilities, right? And you're banking on getting $250 a month per unit at, you know, 80% full, right? I would be sweating too if I was there. All right. But I'm banking on people spending $100 a month or $50 a month, you know, I'd say $100 on average, you know, so $100 on average is a lot less riskier than $250 on average, you know, per month, if that makes sense. All right. So basically the whole point of my spiel today is that you just have to be more conservative about the types of facilities that you buy over the next couple of years and the locations. It's going to be very important. The price per square foot and the price that you charge that unit, and then also the location of where you buy them. And I'm going to tell you, in tertiary markets, you'll be just fine because there is not enough storage facilities in tertiary markets right now. Secondary, typical secondary markets, I think you'll be fine in. The primary markets where they're oversaturated, overbuilt, those are the ones where people are, you know, the owners are going to be sweating a little bit over the next couple of years. Okay. My personal opinion, just all my personal opinion. Okay, let me look at the comments. I saw some comments here too. So let's get into that. And if you have any comments, put them in. Okay. Market correction on takes 18 to 24 months or so to correct once the economy starts to take. Exactly. Yeah. So it's just like it hasn't even really just now starting. It's like just I feel like there's a market correction now. I have been following, I'm telling you, I get like notifications on my phone, and you guys tell me if y'all do this too, but I get notifications on my phone on like all the places I'm interested in purchasing like property in, because we are in the process of like looking for a place to buy property. Like we've been in our RV traveling around trying to figure out where we want to settle down, you know. So everywhere I go, like I was like in Sedona, I was like, oh, I love Sedona, let me just put that on my list, watch properties, you know. And I'm like in from Austin, and I'm from all over, I'm looking at all these properties. And then what happens, and you guys can all do this too, but like I do realtor.com is what I do, and then I set up the notifications, and then they send me like on a day, like literally on a daily basis, it'll say like, you know how many new houses came in and which houses came onto the property and the areas that I'm interested. And then also within the area that I'm interested in, it tells me where all the price drops are. And I'm going to tell y'all right now, there is a lot of price drops. There is a lot of price drops right now. Okay. And the funniest thing is, like, I have been in the real estate industry for 10 years. And I'm going to tell y'all, this time should be like the booming time. This should be the time where you're like selling those properties. I'm telling you, like my goal when I was rehabbing the house would be like, get that property on the market by Memorial Day. Because I'm going to tell you, Memorial Day weekend is the week where everybody's out looking for houses and putting. And so our goal from like February until like June is just like get those houses out and then be done by June, because then it starts tapering off, gets slower and slower. And then you just do like a couple here and there, and it's like not a big deal. Right. But the funniest thing is like now the market is just so it's not slow. It's not like I wouldn't consider it slow. I would just say prices are dropping. Prices are dropping, right? So people are now, essentially the government is doing exactly what they're doing, which is increasing the interest rate so that it corrects the market. And then of course, at the same time, it kicks all the buyers out that couldn't really afford like a first time home. And so it's just kind of they're trying to correct it, but at the same time, it's going to be interesting to see what happens. Anyways, but yeah, so 18 to 24 months. I feel like this is going to be happening for the next 18 to 24 months, just like he said. Who said that? anyways, that was Jim. Yeah, exactly, Jim. I think you're definitely correct. Okay. And let me see what else. Any more comments in the chat before we move? I see some over here. Do you think we should wait like 6 months before buying? No. Who said that? That was Yukiko. Yeah, no. Definitely you should still be buying. See, the one thing I love about commercial real estate is that it's all based on income. You know, it's all based on income, right? So you just have to know, like, you know, you have to know what types of facilities to be looking for, what areas that you should be focusing on, right? But you still should be buying facilities, that's for sure. You definitely don't want to be holding off. All right. You just have to figure out the location and the price and the type of facility. That's gonna be good. That'll sustain you over the next couple of years. Okay. That's what it is. And so I know, like Yukiko, you live like in a primary market, and I don't know what market you're interested in. You might be in Virginia, but you just have to kind of look out into like secondary to tertiary markets. I say secondary to tertiary markets because I know you're in like the DC area. But secondary to tertiary markets is where you should be focusing on. The areas like typically that I teach and look in, those are like the perfect areas. Everything I teach, you could be definitely utilizing it over the next couple of years. And let me see what else. And then credit crunch coming, parts of economy will suffer if they have the debt, interest rates, only the issue valuation will hurt refined opportunity for cash rich buyers. Yeah. I mean, so, you know, we've got debt. I mean, you know, we've got debt on our facilities. There's nothing wrong with having debt, you know. It's just, you know, I don't think there's anything wrong with having debt. You know, it's really, now we are trying to, you know, we're trying to buy some facilities with debt, like going to the bank and getting loans. And I'm going to tell y'all, they're getting stricter. They're getting stricter. All right. So you just have to be aware of that as well, too, that, you know, they may require some more down. They're definitely going to require a bigger down payment. All right. And then on the back end, the interest rate could be higher. Now, I'm not sure what the commercial rate versus the residential is. Like, I don't know if it's going to get over 6%. But see, the thing is like, I've been, you know, I borrow private money to buy my deals. And I pay, like, I've paid up to 10% interest, you know, typically 6 to 10% interest is what I pay. So for me, that's not a big deal. You know, I look for deals where I know I can afford that. That's what I look for, you know. So if you know that you're going to be paying a higher interest rate, then look for deals where you can afford a higher interest rate. That's it. You know what I'm saying? You know, so you just don't want to be like, you know, you don't want to be chintzy with your numbers. You don't want to be like, oh, if I just squeeze this, and you want to be like realistic. You know, you want to be like realistic. I wouldn't say like conservative. I would say realistic. And there's a difference between conservative and realistic, you know, because some people, I feel like they're just like they're way too conservative. Like sometimes I feel like Pete, my husband, is like way too conservative. I'm like, you still have to take the chance. You still have to just sometimes go for it. Okay. So there's that border, you know, as well, if that makes sense. Do you think it'll be so tough that clients can't pay their rent, or we become no? That's why I said we got into that. Like, higher rents will be harder to pay, lower rents you'll be fine. All right, because I've been through COVID and I saw what it is. Now I talked to a couple of people. Like I talked to one lady on the phone, and she was like, "This damn COVID just screwed everything up." She's like, vacant, people moving out. She's like, haven't been able to charge. She's like, everything just got screwed up. And I'm thinking, like, you must not know how to like manage your property properly. All right. You know, first of all, yeah, we gave everybody like, you know, a second chance to pay everything off. But you know, if you work with the people, right, and if you become she was not contactless at all. I mean, you don't have to be there managing everything, but you should be fine. You know, you just have to make sure that you come up with that right price that everybody can afford. And that's just, you can just test it as well too. What's your intuition on the self-storage up or down 25 years in real estate market? My opinion is that it will stay relatively strong this fall, but toughest times are coming. Yeah. So now everybody knows my opinion. My opinion is that secondary and tertiary market facilities are going to be doing just fine. And primary market's going to be struggling, but primary market like higher rents. Okay. And that could be non-climate control or climate control. Another thing that I would consider is just an all climate control facility that you have to base yourself only on that. That would be, I was something I'm not going to buy. Okay. And that's just like more of a risk level. I feel like if you're going to base on all climate control and you're going to base your numbers on like higher numbers, I personally would not be doing that. I would like to have a mix, right? It's okay to have a little bit of climate control and more non-climate, but just be in that price range. You know, your price range is going to be 100 to 200. I would say like 200 is on the high end for climate control. It's just hard. It's just hard for a lot of people to afford it. Now, if you're in a market where like it's higher end market and people will be able to afford more, but like typical secondary and tertiary markets is what I'm talking about. Okay. And this one says, my research has shown that storage does very well in the downtimes. People moving and have storage was displaced. Yes, you are absolutely correct. All right. And that's the one thing I love about storage is that you will be able to make money in the downturns and the upturns. Just be mindful of the price per unit, because that's going to be the key. Affordability is going to be the word of the year. All right. Okay, good comments here. And then I found that he got better results when he raised funds first, and then he was able to make all cash offers, and then after stabilizing the project. Yeah, good. Yeah, so this is kind of what I do with my fund as well too. So I'm raising the money and then getting out there and buying like mismanaged facilities and then stabilizing those within the fund. That's what I'm doing. What else? If the housing market corrects, do you think that will reduce demand for storage in general? No. Yeah, no, there's always a demand for storage. There's always a demand for it. It's just also based on the price as well too, right? So yeah, but definitely there's always a demand for storage. Honestly, demand is getting more and more. So I say new construction is also very good in secondary and tertiary markets as well. I feel like there's not enough storage out there. So demand will always be high, but I just feel like in the primary market, it's going to be a little bit tougher. Okay. Because it's just so oversaturated. In the areas, Cincy, okay, how would you find out the percentage of profits that a complete unit produces? Okay, that's either your IRR or your cash on cash return. I mean, typically cash on cash return is like around 10 to 15%, just because everybody always asks me that. I mean, we're typically 10 to 15%. Every once in a while we get higher than that. But we typically don't ever go lower than that. We're 12, 13, 14, 15% cash on cash return, right? So you just have to consider what your net is going to be. And everybody's net is different because it's all based on your expenses and a whole bunch of factors and everything, but this is not like, people are like, I'm going to go buy an $800,000 facility and I want to make like $100,000 that year. It doesn't work that way. It doesn't work that way. Okay. Net 10%, man, you're doing good. In multifamily, it's also the same way. I would say you should be happy with like 10 to 15% net. And I would just look, when you're running your numbers, just look on cash on cash return is typically like 10, 15%, hoping to get more, but that's basically where you're at. Okay, what returns do you offer equity investors? I'm about to pitch. I'm going to jump off right here in just a minute. And I'm going to go pitch my fund, stacyrossetti.com/fund. Hop on there and listen to me pitching the fund. Anybody can come on and hear me out, and then you can learn about the offering. Okay. Let's see what else. let's see. Now before we hop off, I just want to remind everybody that the Storage Nerds doors are open this week. The last day is Thursday. Doors close. Okay, so if you want to talk to me, then go to storagenerds.com and then go through the application funnel, and then you can get access to my calendar, and we could talk about Storage Nerds. And let's see what else. And then if that's not something that you're interested in, if you're interested in the fund, then you can hop on stacyrossetti.com/fund, or you can go to stacyrossetti.com, and then you can find out all about me. I have all my coaching and my courses and my fund and like everything, free podcasts, free trainings, all kind of stuff right there. So definitely go to my website. You can check me out there as well too. Okay. And I'm here every Monday night as well. But anyways, I'm going to hop off because I do have to go to the fund, but I appreciate you guys hanging in there, listening to my spiel about the market. Overall, the summary is that we're going to be just fine, just as long as you don't, you don't spend a lot of money on those units, right? All right, because I think that's going to be the hard part. And to be sustainable, you have to be able to be affordable. So affordability, not to you, affordability to the tenant. That's what you have to keep in mind. Does that sound like something that would be affordable to the tenant in this market? Now, obviously in New York City, people can pay $500 a month, right? But can they pay that in, Jacksonville? That's a different question, right? That's the question. All right, awesome. There's a lot of comments here as well too. And I want to say also, make sure you join the Facebook group. And Super Simple Self-Storage is the Facebook group, and that's where we're there answering questions. Lots of engagement and stuff is there as well too. Okay.
Thank you for joining us for this episode of Storage Nerds. Hope this informative conversation inspired you to go out there and jump into this highly profitable business venture that people rarely talk about. Get more tips on storage space investing at www.stacyrossetti.com. Don't forget to subscribe to the show and leave a rating. Together, let's build that thriving passive income one storage space at a time. Until next time.